Welcome to the I Know program of modules designed to help people new to business. This is 7.3, Pitching for Equity Finance. The materials that you're looking at have been made possible by the I Know project, which is funded from European funding, and the materials have been developed at the Centre for Entrepreneurship and Business Incubation here at the University of Malta. Slide number 2 illustrates the full curriculum, and you'll see that we're here in track number 7. Which provides an introduction to pitching and likely finance questions when you're seeking business finance. Slide number 3 illustrates the need to raise finance. It's quite straightforward, really, and this shape of business finance applies more or less to all startup businesses. Essentially, more money goes out of the business account to begin with than money coming in, and so that creates a shortfall. To run the business, you'll need to cover that shortfall. So what you really need to know is how much do you need and over what period, how much and how long. There are 3 main ways to raise business finance apart from sales revenue, as you can see on slide 4. Grant funding, which doesn't need to be repaid, debt finance, a loan that has to be repaid, and equity finance, when an investor buys shares. This presentation will look at equity finance. Now that can cover initial funding needs, or maybe to access working capital, access funding for growth, or enable the purchase of major capital items, although that's less likely to be the case with equity finance. So what is it? Well, slide 5 indicates that equity finance is a way of raising cash for the business by selling new shares, which of course is only possible with a private limited company. The founders do not sell their own shares, rather, investors buy new shares and become owners alongside them, with ownership in proportion to the number of shares that they hold. It's only possible to attract investors, however, when the business has great potential for growth and has an exit strategy so that investors can sell the shares they've bought at a later stage and make a profit. So, slide number 6 indicates when to raise equity finance, and you can see it's the same shape of business finance graph, but in red you'll see the text is indicating if the amount of cash needed and the period before any possible repayment are large, then debt finance will be unlikely and equity finance will be required. Do bear in mind, however, that equity finance may be raised over multiple rounds. Slide 7 reminds you why investors buy shares. Quite simply, they want to make a capital gain, in which they buy shares at one price and then sell shares at a later date for a price higher than the one they purchased the shares for. In order to buy the shares, however, an investor has to be persuaded that the company has an excellent opportunity for growth and a management team capable of achieving the milestones set out in the business plan. Potential investors will almost always want to meet the management team, receive a presentation, and be able to ask questions. Slide 8 continues with what investors are looking for. For trading businesses, then the profit and loss and the balance sheet will be assessed. But the business plan and cash flow forecast will definitely be assessed, irrespective of the stage of the business. But that's not normally read by an investor until they've heard from you a short presentation, perhaps 15 to 20 minutes. For a new business, the profit and loss and balance sheet are not critical, since there are no trading figures available, and the company should have few assets, if any, on the balance sheet. Slide 9 indicates what's the most important thing. The truth is, it's the management team. Private investors get approached by many companies seeking to raise equity finance. The business idea is viewed as important, but perhaps not as important as the management team's ability to deliver it. The key question is whether the management team can lead the company through the milestones identified in the business plan and to do so on time and on budget, as defined in the cash flow forecast. Slide number 10 gives some idea about where to start. So the process begins with the business plan and the associated cash flow forecast. Within the plan must be a list of specific milestones that, once achieved, will reflect progress and add value to the company. Do remember that cash should be used to make progress and not make purchases, and so capital expenditure should be minimised. Business plans often cover a 3-year period, and the cash flow forecast will determine the investment required to support that. In terms of valuations and share price, please refer back to Module 6.6, Valuing a Business, in the series if you've not already been through it, as indicated on slide 11. The next few slides, when you've had a look at 6.6, illustrate a case study of equity finance for a specific business. Once we've reviewed that, we'll discuss what kind of presentation was made to the investors at round 3 for that business. Now you'll see on slide 12 that XYZ Limited, the startup case study, is very simple, and this is the first round, and this is the issue of shares to the founders. Now note that a lot of shares are issued so as to ensure that later rounds have a share price of less than €10. That's a very common thing to do. Also note that the pre-money valuation at this stage may be the same as the post-money valuation, simply because the company doesn't have any assets, so its value is what cash it has at the bank. You'll notice here that the founders invested €60,000 at the outset. So this first round of investment then, the founders have started the company and they've put in $60,000, but now they need to seek equity finance investment. And so they decided to go forward and try to get that from friends and family. That's not uncommon at all. To raise equity finance, they issue some new shares, and they set a price of €0.46, so that by selling 200,000 new shares, they raise €92,000. Because more shares have been issued, the founders who originally had 100% are now diluted to 83.33%, and the friends and family have 16.67%. Take a look at the next slide, which is slide 14, to see how that breaks down. Please note that the founders now have 1 million shares, just the same as they previously had. But now, the price of those have gone up, because these shares have been sold to the new investors. And so if we multiply the shares held already by the founders by the new price, it's showing that the company is adding value because the share price is going up. Turning now to slide 15, let's think now about moving into the more professional area of equity finance. And this is now dealing with business angels. These are investors who are prepared to put money into new business in exchange for equity shares in the company. Now, in the example, you'll see that the founders spend the money that they raised from friends and family, and they add value to the company by making progress. And that progress is managed by hitting the milestones outlined in the business plan. Their new cash flow forecast indicates that they need to raise over €400,000 for the next phase of business development. So the founders decided to raise €450,000 by selling 500,000 new shares to business angels, who then hold 29.41% of the issued shares. You can see that on the next slide, which is number 16. So at round 3, the business has been able to issue new shares. It's been able to issue new shares at a higher price than the last round, and as a consequence, raise 450,000. So we have a pre-money valuation. That simply is the new share price that's been set, multiplied by the shares that were previously in existence. That's the pre-money valuation. And then the post-money valuation. So that's no more than the pre-money to which one adds the cash that's been raised. So that's the post-money. Slide 17 reminds us that the important thing for equity finance is about profit, progress, and perception. The valuation takes no account of sales revenue or profit, since the business is not yet trading. And so investors buy shares in the belief that the business opportunity is good and the founders are capable of delivering the business plan. Progress is all important for the increasing value of the company and hence the rising share price. Now, on this occasion, luckily the founders had had help from an experienced entrepreneur who guided them through the options and defined a funding strategy. Slide 18 points out that equity finance is not easy. It's difficult, and founders should therefore get the best advice possible. Common mistakes can arise over valuation, simply setting the share price too high or too low, and oddly enough, raising too little money. That means you can't deliver the business plan. Or too much money. That means you've wasted too much equity in a funding round. Now, always get very good professional advice where possible and when funds permit. Please do avoid self-proclaimed mentors and unaccredited accelerators that lack the experience to advise. It's likely that your accountant will be able to give you a recommendation as to people you might wish to work with. Always get experienced entrepreneurs to help you, and your own accounting firm may know of people that would be interested in helping you and even in possibly investing in you. Slide 19 indicates what goes into the pitch. Now, this is really a presentation that includes key information from the business plan and its associated cash flow forecast. Of course, the executive summary of the business plan includes the very same information. So it makes sense to base your pitch upon that executive summary. So do review Module 5.4, the executive summary, if you've not already done so. Slide number 20 sets out a 20-slide recommendation for the components of what you may wish to present. It's pretty straightforward. It starts off with a title slide, an introduction, a review of the technology, the company's intellectual property position, a description of the market, target products, a competitor analysis, what is your commercial strategy, and what do you calculate your market potential to be, based upon market research data, of course. And then who's the management team? If you have any R&D plans, provide summaries of them next. And then what will be your overall operating plan? Within that, number 13, what are the key milestones? And from that also follows, what are the resource requirements that you'll need? Now, that does cover people. It covers things that you may need in terms of equipment, but it also covers the cash that you'll need. And that, in turn, is summarized with a single number on slide 16. How much investment are you seeking? 17, 18, and 19 are really focused on investor questions. Firstly, we need to tell them the details of this share issue, what percentage overall is being offered, what is the share price, closing dates, and so on. Slide 18 relates to your future funding needs. It's never the case that every funding round just covers a single period and then no more money is required. It's most likely that a high-tech, high-growth company will raise money over several funding rounds, and that will be explained in slide 19 of this sequence. But then we end on 20 with 20 questions. And we think that's a very sensible format. Now, everything you need to include should already be in your business plan. For a 20-minute presentation, then 20 slides are recommended as the maximum number. That works to a delivery of 1 slide per minute. Keep to a maximum of 5 bullet points per slide. There's often a temptation to pack in too much information. Try to resist that. Bear in mind that with 1 key message per bullet point, then 20 slides cover 100 key messages. That's more than enough to deliver a comprehensive pitch. Slide 22 tells you some of the tips that we want you to remember. Firstly, avoid jargon and acronyms. Use plain English. Using a short supportive video is fine, but allow no more than 10% of your presentation time for that. So obviously a 2-minute video will be fine within a 20-minute presentation. Always have hard copies of your slides. Sometimes technology lets you down, and usually it's at the worst possible time. If you have to you can always speak to hard copies rather than presenting a PowerPoint presentation. When it comes to the questions, make sure you keep your answers relatively concise. You could consider having extra slides with supplemental information to help answer probing questions if you wish. Finally, slide 23 tells you to remember that equity finance, the pitch, is not the place to negotiate share price. Set your share price and get advice and feedback from your accountant and other advisors well ahead of the pitch. Remember that your pitch may not attract investment from every investor that you speak to, and so be prepared to make multiple pitches until you've raised the amount of finance that you see. Slide 24 is just thanking you for attention. That's what we'd say if we're in a classroom setting. But for now, let me just simply say thank you for listening.